If you've got $100,000 sitting in an offset account or a term deposit right now, in August 2026, the standard advice tells you there are two paths. Put it into an ASX 200 index fund and let it ride in your own name, or tip it straight into your super. Most people treat that choice like it's a coin flip. It isn't, and the rules that decide it just changed. Here's the number that changes the whole conversation. New 2026 rules on contribution caps and capital gains could turn what feels like a safe, flexible choice into a $240,000 mistake by the time you turn 67. That's not scare talk. That's what the math shows once you run $100,000 through both paths side by side. Most guides gloss over this part. Keeping money outside super feels like control. You can see it, you can touch it, you can move it whenever you want. It's an easy trap to fall into, because on paper, both paths look like they're doing the same job. I've watched this happen more times than I can count. People who did everything right on paper except the tax part. So today we're going to stress test $100,000 across both paths using the actual 2026 caps and thresholds, not the numbers from 2 years ago that half the internet is still quoting. I'll show you the exact point where the math flips in super's favor, no matter how much you don't trust having your money locked away. And by the end, you'll know whether that $240,000 gap applies to you, or whether you're the exception. In 2026, the gap between the two paths got wider, not narrower. The concessional contribution cap just moved to $32,500 a year, up from $30,000, and the non-concessional cap sits at $130,000. Those numbers matter because they change how much of your $100,000 you can actually shift into the lower tax world of super before the 30th of June 2027. The ATO publishes these caps every year specifically because they reset on the 1st of July, so the $32,500 figure you're working with is confirmed and locked in for this financial year, not an estimate. Outside super, in your own name, the dividends and gains your $100,000 earns get taxed at your marginal rate. For a lot of people still working part-time or drawing other income in their late 50s and early 60s, that's 30% or 37%, plus the 2% Medicare levy on top. Inside super, the same earnings are taxed at 15% at most, while you're still accumulating. Once you move into pension phase at 60, that tax rate drops to zero. That gap between 39% and 15% doesn't reset each year either. It compounds because every dollar you don't lose to tax keeps earning inside the fund. But the cap increase isn't actually the headline. The real story is what happens to the profit your money makes once it's sitting in one place versus the other. And that story is a lot more expensive than most people realize. I think of this as the moment your need for control starts costing you real money. Wanting to keep an eye on your own portfolio is normal. But once that preference is costing you more than $5,000 a year in extra tax, it stops being a preference and starts being a leak. Put real numbers on it. Say your $100,000 grows by 8% in a year. That's $8,000 in profit, held outside super and taxed at around 39% combined. You keep $4,880 of it. Held inside super and taxed at 15%, you keep $6,800. That's $1,920 gone in year one alone, before you've even touched the money. The trade-off is real, though. Locking money inside super means you can't touch it until you meet a condition of release, usually reaching 60 and retiring, or turning 65. If you need that cash for something in the next few years, you've traded flexibility for a tax saving you can't spend yet. That's the cost most guides skip over. Tax on income isn't even the biggest issue, though. There's a change to how capital gains get treated in 2026 that makes holding shares in your own name riskier than most people think, especially if your balance is bigger than $100,000. It's the kind of change that rewards people who move early and quietly penalizes everyone who waits. There are three rule changes stacked on top of each other in 2026 that tilt this decision harder than most people realize. I call it the triple lock, and once you see how the three pieces fit together, the case for moving that $100,000 gets a lot clearer. Start with capital gains. Outside super, when you sell shares you've held over 12 months, you get a 50% discount on the gain before it's taxed at your marginal rate. That sounds generous, but it's also the discount politicians talk about trimming almost every budget cycle. Inside super, the fund pays 15% on capital gains and gets its own one-third discount on assets held over 12 months, which works out to an effective rate of about 10%. Right now, super's version of that discount is the steadier one. It's baked into how funds are taxed, not sitting on a list of things that could change in the next budget. Then there's Division 296, the new tax that starts on the 1st of July, 2026, for anyone with a total super balance over $3 million. If your balance sits between $3 million and $10 million, you pay an extra 15% on the earnings, real income and gains that get realized, not on paper increases. Above $10 million, that extra tax rises to 25%. If you're moving $100,000 into super, you are nowhere near that threshold, so this one doesn't touch you directly. But it tells you something useful. The government is still treating super as the more attractive place to hold money long term. Otherwise, it wouldn't bother taxing the very top end differently at all. The third piece is the one most people your age have never used. If your total super balance is under $500,000, you can carry forward up to 5 years of unused concessional contribution caps. With the cap now at $32,500 a year, that can add up to well over $100,000 in extra space, all taxed going in at 15% instead of your marginal rate. If you've got a few years of unused space sitting from when the cap was lower, at $27,500 or $30,000, stacked on top of this year's $32,500, that's easily enough room to absorb the full $100,000 in a single financial year. That's the mechanism that lets you move a lump sum like $100,000 into super in one go, using room you've already earned but never used. I used to tell people to keep around 30% of their money outside super, just in case. I don't say that anymore. With deeming rates now at 3.25% on the upper band, the cost of leaving money sitting outside in a low-interest account, doing very little, has gotten too high to justify calling it a safety strategy. That said, it cuts both ways. Once it's in super, you're trusting a system you don't fully control, and that trust has to be earned, not assumed. Picture a $10,000 gain on that $100,000 either way. Outside super, taxed at your marginal rate after the 50% discount, you might keep around $8,050 of it. Inside super, once you're drawing a pension phase income after 60, that same $10,000 gain is taxed at zero. That's not a rounding error. That's just under $2,000 gone on a single sale. If you're 55, you're only 5 years from that zero tax mark. So why does anyone still keep the bulk of their money outside super paying tax the whole way there? Usually it comes down to one thing, and it's not really about tax at all. It's about what happens the day the market drops 15% and you're staring at your own trading account. There's a bias worth naming here, the liquidity illusion. Having $100,000 sitting in a broker account you can log into any time feels safe. It feels like you're the one in the driver's seat. And honestly, that feeling is completely normal. Nobody wants their savings locked somewhere they can't reach in an emergency. But for someone in their late 50s or 60s, money you can reach easily is also money you're more likely to touch at the worst possible time. When the market drops 15%, the person with $100,000 sitting in their own name sees a sell button every single day the market is open. Some people check their balance every single day the market is open, and every check is another chance to talk themselves into selling. The person with that same money inside super, especially once it's in pension phase, doesn't get that daily temptation. The structure itself removes the decision. This is not really about willpower. It's about how the account is built. I've seen people do this without realizing it, sell out of fear, and quietly call it being careful. An account you can sell out of in 30 seconds will get sold out of eventually, usually right when prices are down, which locks in the loss instead of riding it out. The reframe that actually works for most people is simple. Instead of keeping the full $100,000 sitting exposed in shares outside super, keep around 2 years of living expenses in a high-interest savings account or your mortgage offset. Move the rest towards super. That 2-year buffer covers the emergencies, the new car, the unexpected bill, without you ever needing to touch the growth portion of your money while it's down. It also means you stop making decisions based on what the market did this morning and start making them based on what you'll actually need over the next 2 years. Think about the kind of bill that actually derails people: a car that needs replacing, a big Medicare gap payment, a strata levy that lands out of nowhere. 2 years of buffer covers all of that without forcing a single stock sale. If you're trying to get your head around these 2026 rule changes without handing more of your money to the ATO than you need to, that's exactly what this channel is for. Subscribe to Aussie Retirement with Bob. We track the caps and the thresholds, so you don't have to chase them down yourself. Let's make this real with a scenario. A 15% downturn hits right as two different people turn 60, both holding the same $100,000, both about to make a very different decision. This age matters because it's exactly when a lot of people stop adding to their savings and start drawing them down instead. The timing of a downturn stops being a hypothetical and starts deciding how much of that $100,000 actually reaches retirement. Nothing else about their situation is different, only the timing of one bad month. Gary kept his $100,000 in shares outside super. His car dies and he needs cash. With the market down, he sells at the bottom, locking in a loss of around $15,000. And because some of those shares had gained value over the years, he still owes capital gains tax on the older parts of the sale. One bad timing decision costs him twice. Run that same $15,000 forward instead of selling it. Left invested and growing at a modest 7% a year, by the time Gary reaches 67 7 years later, it would have grown to around $24,100. That's not the $15,000 he lost. That's the money he never got the chance to make. And it's usually the bigger number nobody talks about. Susan put her $100,000 into super and moved into pension phase at 60. When she needs cash for a similar expense, she draws from a tax-free income stream instead. Her own 2-year buffer, sitting outside super in a high-interest account earning a bit over 4%, covers the immediate cost. She never has to sell a single share while the market is down. This is the difference between a plan that survives a bad year and one that doesn't. According to ASFA's 2026 figures, a single person needs around $630,000 by 67 to fund a comfortable retirement. Every forced sale during a downturn, like Gary's, pushes that number further out of reach, not because the market failed him, but because the structure he chose forced his hand. It also means the $630,000 target isn't just about how much you save, it's about how much you're forced to give back when the timing turns against you. Susan comes out ahead because she understood how pension phase actually works. But there's a catch even she needs to watch for. Because once you're drawing the age pension too, having money sitting in the wrong place can quietly shrink your payment without you noticing. Here's something a lot of people don't realize until it happens to them. Once you reach age pension age at 67, that $100,000 in super doesn't sit quietly in the background anymore. It gets counted, both for the assets test and for something called deeming. This catches people off guard because nothing about their $100,000 has actually changed. They haven't spent it. They haven't moved it. The only thing that changed is their age. Deeming works like this. Services Australia assumes your financial assets earn a set rate of return, currently 1.25%, on the first $64,200 for a single person, and 3.25% on anything above that, regardless of what the money is actually earning. If your $100,000 is sitting in a bank account paying 0.4%, it doesn't matter. Centrelink still counts it as if it's earning the deemed rate, and that deemed income affects how much age pension you receive. That's the trade the deeming rules make. Simplicity for the system, unpredictability for you. On the asset side, a single homeowner can hold up to $333,000 in assessable assets and still get the full pension. For a couple who own their home, that combined threshold sits at $499,000. Go over the limit, and the pension reduces by $3 a fortnight for every $1,000 you're over. If you're $10,000 over that line, that's roughly $780 a year in reduced pension every year for as long as you stay over it. It's not a wall you hit, it's a slow leak, and most people don't notice it until their payment has already shrunk. None of this means avoid super. It means know what you're walking into before you get there, because the same $100,000 that saved you tax at 55 can quietly cost you pension at 67 if you don't plan around it. So the actual move breaks down into 3 steps. First, check your total super balance. If it's under $500,000, look at how many years of unused concessional cap space you're sitting on, because that space disappears if you don't use it. Second, prioritize the new $32,500 cap before the 30th of June 2027. That's where the biggest tax saving sits. Third, set aside 2 years of expenses outside super in a high interest account, so you're never forced to sell shares or dip into your retirement money at the wrong moment. Most people stop right there, and that's fine. But there's one more check worth doing before you move a single dollar, and it has nothing to do with the numbers. When you strip away the noise, super wins on tax. 0% in pension phase versus up to 39% outside it. Shares in your own name still win on something else though, the feeling of control. In 2026, with the caps and thresholds where they are, that gap has gotten too wide to ignore just to keep that feeling. If this saved you from a costly guess, subscribe for more Australian-specific retirement math, the kind that actually matches this year's rules, not 2 years ago's. Retirement was never really about having the most money sitting in an account. It's about having the most choices when you need them. Use the 2026 rules while they're in your favour, and let them buy you that freedom.